From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the lowest monthly jobs print in 4 years, with just 12,000 payrolls added in October, and traders reloading bets on Fed rate cuts heading into next week's decision. And with all eyes on the U.S. presidential election just days away, we begin with the big issue, looking beyond that noisy jobs print.
Yes, this is a downside disappointment, but the broader message is labor markets have been normalizing.
On the whole, I think the data are consistent with an economy that's still robust.
It's important for us to also acknowledge that labor market's going to be noisy.
You got an economy that's still pretty good. You know, at the margin, softening a little bit allows the Fed to bring the funds rate down to 4%.
It's really hard for them to not cut in November. In December, it's fairly likely they'll skip.
It's pretty clear they're going to cut rates in next week, and it also increases the probability of December.
The one thing that would have really moved things is a much stronger number, not a much weaker number.
This makes their life easier. It would have been harder if this was a big upside surprise.
It should be cutting by 25 basis points for the next few meetings, and then revisiting after that.
The U.S. economy is okay, and the Fed is not going to be cutting rates by 150 to 200 basis points.
The economy is good. The Fed has the power to do what it needs to do.
Speaking of the Fed decision, bond traders gearing up for a potential sell-off in U.S. Treasuries with the election just days away. We're going to take a look here at the 10-year over the last 3 days, because the steady climb above 4.3%, you got up to 4.35 a little earlier today. You can see that despite the data, you have seen that steady drift higher. You saw a decline just even a little earlier today, more in line with what you saw at the short end of the curve, but certainly you've seen more of a decoupling as the day went on. And certainly that has been the direction of travel for not just one day, but certainly a number of them. We are going to flip up the board here and not talk about the long term, but about the shorter term as well. These are the expectations. And yes, we are looking long term, but even shorter term. You could see finally after that jobs data this morning, the one thing that became even more for certain is the fact that in November, traders are expecting that next rate cut. You can see that they expect still a steady decline in rates through the middle and end of 2025, with overnight really reaching about 3.5%. We'll keep an eye on this. It's a big topic of discussion on whether the Fed can achieve that many rate cuts still. Of course, it has been a long road to get here. The market has been wrong most of the year, but of course the time now has come. And with our election right around the corner, we spoke to Ed Yardeni earlier at Bloomberg, saying that rising yields could signal the return of bond vigilantes.
The bond vigilantes are definitely mounting up. There's a possibility here that if we get a sweep of either the Democrats or the Republicans, the bond market will conclude that nothing will stop either party from spending a lot, maybe cutting taxes a lot for some folks, not for others, and all in all, continuing to widen the deficit and the debt. Meanwhile, the interest payments continue to accumulate and will probably hit $1 trillion, which will make lots of headlines within the next few months.
Joining us now, Subadra Rajappa of SocGen and Gennadiy Goldberg of TD Securities. And Subadra, we were talking about the disconnect between the short end and the long end. But let's start at that short end first, because it's so contingent on what we'll see in less than a week from now, both the election and that FOMC meeting. Can the Fed cut twice this year comfortably?
Possibly. And if anything, today's data puts them on track for a cut at the November meeting and a cut at the December meeting. I think beyond that, when they've now gotten, say, 100 basis points of cuts for this year out of the way, that's when really we start thinking about whether they can cut in every meeting after that point on. Our call is that from that point on next year, it's going to be much more of a one cut per quarter type cadence as opposed to one cut per meeting for this year. I mean, the data has been relatively strong. Yes, we got a weak payroll print, but we're seeing decent momentum in growth heading into the fourth quarter. Manufacturing data that we got today was also on the weaker side, but we've been in a manufacturing recession. The services side of the economy is still doing relatively well, and consumers are really doing well. So that's what we're looking towards is good strength and momentum going into the fourth quarter. Perhaps justifies a couple of more cuts for this year, but then beyond that, they probably take a much more measured pace.
How much uncertainty is there, Gennadiy? Because if you think about what we saw this morning and how much we still don't know, we don't really know the impact that the hurricanes had on the jobs data. Do you believe that this economy could be a lot weaker than it looks given the revisions? Do you think the Fed needs to cut twice?
I think the next two are quite likely. I mean, certainly we'll have to see a pretty big reversion in the way things go between now and the December meeting. There's not that much more data that would really kind of knock them off course. Certainly that you're probably going to have an upside surprise or a kind of a spike in payrolls when you get the rebound from this low number. The issue here is the run rate, right? The run rate over the last 3 months is now just north of 100K. You're really getting to a territory where the break-even's quite uncertain. You could be running just at or even below break-even. And if you look at the unrounded unemployment rates, I know it's still 4.1, but it's really 4.14. And it was just a hair away from actually ticking up to 4.2. And I think the market would have gotten much more nervous had you actually had that 4.2 come through.
Well, that plus the labor force participation rate, clearly a noisy data set. But even more noisy, Subadra, is that election thrown on top of the cocktail of risks in the economy. You see maybe the most pronounced move here on the longer end of the curve. But where else are there risks as it pertains to the bond market with this election just days away?
Yeah, no, definitely. I think a Trump win and a Republican sweep, in my view, is an underpriced risk. We could see a meaningful sell-off from here if that were to be the outcome come Wednesday. You're starting to see some concession getting built into the auctions for next week, because it's going to be very, very tricky for the market to take down that additional supply that's going to come, especially supply that's going to come into the long end. So you're seeing that concession already starting to build into the market. It's going to be very, very interesting to see what the price action is after we get some of the initial results. And then, of course, the outcome of the elections are going to be quite meaningful in the trajectory for debt and deficits over the longer run. So we'll be paying close attention to the price action over the short term, but also how the market digests the outcomes for the longer run.
You know, Gennadiy, that idea that you could see an even bigger sell-off, where do you think the 10-year goes if Trump wins?
I think you
get a Republican sweep to her.
Right. So if you get the red wave, I think you get closer to 5%, maybe not necessarily 5% on the 10-year, but I think you could certainly test quite a bit higher. The issue that I have with that is we've already sold off quite a bit. I think the market's already been selling off on the increased odds of a Trump victory and red wave. So I think a lot of it's already in the price. What I'm actually a little bit nervous about is, the betting markets are basically pricing in, call it about 60-65% odds that Trump actually takes it. If it's Harris and there's an unexpected surprise the other way, we could see a pretty meaningful snapback in the rates market, especially as the market's been setting up here. So I don't know if there's that much of an additional sell-off if Trump actually takes it, but there could be quite a bit of a snapback as well.
It's an incredible conversation. You say 5%. Speaking of election bond vigilantes, I spoke earlier this week with my colleagues too, Neil Grossman. He said you could get as high as 7% over time. Take a quick listen.
If you go back to the 1992 election, interestingly enough, as George Bush was segueing to Clinton, we were just coming out of a recession, but at that point in time, the yield curve was about 400 basis points steep. I think the 3-year, if I remember, the 2-year note was sitting around 3 to 3.5, and the long rates were in the 7.5. To me, there's no reason why this type of yield curve is not something we may be looking at, which is a very scary outcome.
With a 7% 10-year.
Why not?
Subadra, there is a huge range of predictions out there on just how much the 10-year can really start to take off in terms of where its yields can go. Where do you think it goes? If Gennadiy thinks 5% just on a Trump win Republican sweep, what is the direction of travel?
Yeah, no, that sort of scenario, definitely makes sense. We do expect a little bit more of a sell-off, maybe by as much as 50 basis points in the event of a Republican sweep. But really, my concern is that if we do see a meaningful sell-off in bond yields, you're going to see that reverberate across all risky assets. I mean, for now, I think equities are still holding up. Credit spreads are extraordinarily tight. We're looking at a much higher rate regime for longer. The impact of that is definitely going to be felt across the board in risky assets and across the board, even globally, because you're looking at a lot of the other countries, emerging market countries, where the reaction function is very much pegged on where the 10-year yield eventually ends up. And a dramatic strengthening of the dollar as well under those circumstances could be something that could be quite impactful for risky assets. So I'd be looking at financial conditions and what happens there. And that's where you're going to see a significant tightening of financial conditions under that scenario.
Subadra, what's on your launch pad on election night? What are the assets you're going to be looking at?
I'll be looking at what the reaction function is, first and foremost in the bond market. The dollar is going to be somewhere where we could see a decent reaction if in the event of a Trump win, and the potential for tariffs. Gold has been somewhere where we've seen a lot of price action already. I'd say that some of the other markets that have not fully priced in the Trump trade are going to see perhaps a much more meaningful move, perhaps in equities as well as in credit. I'd be looking to see what the reaction is in bonds as well as in risky assets.
Gennadiy, where is the 10-year in a Harris win?
I think the Harris win scenario, you could certainly revisit the 4% mark. I think you start to go back to the fundamentals, and I think that's the important thing, is Harris represents, I think, to markets a lot more of the status quo, especially in a split government scenario. I think you head back towards 4%. You then continue to watch the macro. And the macro, as you said earlier, is extremely noisy. And you go back from there.
Not to mention the Republicans might not let her spend many more dollars. Gennadiy, thank you so much. Of course, that is Subadra Rajappa of SocGen and Gennadiy Goldberg of TD. And up next, the auction block, the busiest October for U.S. high-grade issuance since 2021. Just so much activity before that election. We'll talk about it. This is Real Yield on Bloomberg. I'm Sonali Basak. This is Bloomberg Real Yield, and it's time now for the auction block, where we're going to take a trip around the credit world. We saw no deals in Europe to close out the week as countries observed a bank holiday for All Saints holiday. The bond sales were mostly front-loaded, totaling 30 billion euros this week. Over in the U.S., the week's 27 billion worth of high-grade issuance made October to be the biggest in volume since 2021, despite ending the month without a single new deal. And in high yield, two issuers sold a combined $1 billion of junk bonds on Thursday, wrapping up the busiest October in 3 years. And speaking of debt, Chris Verone of Strategia says the credit market has been unstirred by higher rates.
As rates have gone up here, what hasn't happened, there's been no weakness in credit. I mean, double B spreads are on the low, triple C spreads are on the low. Maybe there's a hint of spread widening in MBS, but for the most part, credit conditions are not kind of confirming the move you've seen in yields. I see better data. I see cyclicals outperforming. I don't think the market is as agitated about the move in yields as the consensus is.
Joining us now, Winnie, Cisar, Global Head of Strategy at CreditSights, and Matthew Mish, Head of Credit Strategy at UBS. We are down with the strategy table today. Winnie, it's interesting because strong economy is what you hear over and over. Let's try to merge the macro with the micro a little bit and what's happening among companies and sectors in areas that are weaker. The manufacturing data is clearly weak. And what does that mean for corporations that are seeking to tap the capital markets?
Well, you are exactly right. Manufacturing data have been weak for really quite some time at this point, going on effectively 2 years. It has really not meant much for these companies that have been looking to raise capital, especially as of late. Now, October issuance has been very much dominated by financials coming out of earnings blackouts, but capital market conditions, we've seen Boeing come to the equity market with also a convertible note as well, are pretty attractive across a lot of these sectors and industries that feel like they don't have quite the same momentum as consumer and services. And I think that just goes to too many dollars chasing too few deals across a wide range of markets right now.
Too many dollars, too few deals, and a thirst for yields. Matt, when you think about just how people have been ignoring any signs of trouble here, I mean, is that warranted, or are there risks that more investors should be paying attention to?
We think it's largely warranted. We have an economy that we think is definitively in a softish landing. I think the risk of a hard landing or recession has come down in our view. No landing is still a persistent risk, but there's two flavors of that we see. One is demand-driven no landing, in which case the near-term outlook for profits in the economy are actually stronger than what the market's looking for. And as a result, you ultimately get that inflation impulse, but it's lagged. I don't think that's very negative for credit, at least in the near term. The more risky scenario is no landing, but you get a supply side shock, something that is a supply chain issue with oil or technology. That certainly would have more of an impact, we think, on corporate profits. But I think the overall outlook for credit is fairly sanguine. We have default rates plateauing or stabilizing. We're coming into an election, which is touched on earlier. Seems like, the front runner is certainly President Trump, potentially a red sweep. And we think that's going to be the best outcome for credit spreads. So when you think about financial conditions after the election, you really have to ask, what is the direction of credit spreads? And if the offshore betting markets are right, we think the overall outlook for credit spreads is quite positive.
Winnie, that sets the stage significantly for some risk appetite into 2025. But to Matt's point, there's election uncertainty baked into this, too. How do two different outcomes in terms of two different presidents really change the course of travel next year for credit markets?
This is a really interesting one, especially if you look back at the most recent two election cycles that had very different outcomes, blue sweep and red wave in 2020 and 2016. And markets rallied significantly across the board, across equities, across credit markets on the back of those two elections. Now, the starting point for valuations was very different. We were recovering from COVID. We were recovering from the commodity shock in 2016. So it's definitely not an apples to apples comparison. And you really have to go all the way back to 2004 to make a comparison to at least credit market valuations in an election cycle. And they did fairly well over the short term, over the 3 to 6 month period. But 12 months later, a little bit more of a drift sideways in spreads. And so what we're telling clients is try to look through a lot of this election noise, really at the economic fundamentals and the reality that we're entering the consolidation phase of the credit cycle, much more of the middle stages where we're going to be seeing companies try to pursue some financial engineering, spinoffs, M&A, really use their balance sheets to continue to drive fairly aggressive earnings growth, which is probably just going to naturally slow down as we get into that more middling stage of the economic and business cycle.
I'm interested a lot in that kind of M&A trade, this leveraged loan trade, because on one hand, you have a lot of investment bankers who say that either way, no matter who you have as president, you're still going to have a lot of that deal activity pick up. Matt, how much does this market need that supply at this juncture, and how much risk appetite is there to start to buy into LBOs, large LBOs even?
Certainly, we think under a Trump administration, particularly if it's a red sweep, the two key drivers of credit, one is deregulation. The second is potentially lower corporate tax rates. So if you take the first, we do think that regulation, particularly for some of the large public deals in sectors like tech, has been a real overhang. I think the other thing that I would just make maybe a contrast to some of the earlier speakers is, we're a little bit more sanguine on this view of a red sweep and what it means for 10-year rates in the U.S. So my colleagues, very quick to point out that, we're running a large deficit. That is going to continue whether or not you're in a red or a blue sweep. We think the tariff news is going to come out more gradually, similar to the way it did in the Trump first administration. And then also that a lot of this supply won't actually pick up until 2026 and 2027. So the bottom line is, I think we have a slightly more sanguine view that even in a red sweep, corporate bond yields are not rising. And so if you have that mix of deregulation, fairly stable yields, and a pro-market perceived administration, I think you really will see the gears really heat up for M&A, particularly some of the sponsor activity, which makes its way into financing, both in a leveraged loan, but also the private credit markets.
Winnie, it's not just M&A either. You think about just this morning, for example, companies like Chevron looking at debt markets to help capital return plans really hit the market at a significant speed, if you will. What do you think about that dynamic? Do you think that's just going to pick up as well?
I think it's a little bit more nuanced there. in order for those types of initiatives to really pay off for management teams, you still need to have a relatively low cost of debt. And we know that across the rating spectrum, the cost of debt has increased significantly, not just from the lows of the pandemic period, but also compared to where we were in, say, 2014 or even 2019 at the beginning of that year. So I think that there is some willingness from management teams to look at their balance sheets and say, where can we use incremental leverage to drive equity returns? But I would be hard pressed to find that really well down the rating spectrum, even into the world of double Bs, where yields are much higher than they were previously. You know, borrowing with a 6.5% coupon versus a 4% coupon, that really changes the dynamic and the math on some of these shareholder return initiatives.
A lot of math to really bake down, especially as we actually get some more clarity, maybe in the coming days, hopefully in the coming weeks. Winnie, Cisar of CreditSights and Matt Mish of UBS. Looking forward to catching up with you in the coming weeks. And still ahead, we have the final spread. The week ahead, two key events and massive ones. The U.S. election and a Fed decision. We're going to talk about what to expect. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, what a week. Coming up Monday, U.S., we have a little data. We have durable goods that morning, plus earnings from Berkshire Hathaway, Marriott, Ryanair, CEO Michael O'Leary on Bloomberg TV, and Tuesday, the big election day, along with IM7 Services and earnings from Apollo, actually, as well. Wednesday, election results continue, plus we'll get S&P Global PMIs, and Thursday, the Fed's November decision, and around a weekly jobless claims. Friday, consumer sentiment data from University of Michigan, plus more earnings from Paramount and Spirit Airlines. And for my final thought, let's just take a quick look at something interesting from today's jobs report. 47.7%. That's the lowest response rate from businesses since 1991. Likely a reflection of the two hurricanes cutting the collection period short. The BLS data continues to survey firms in the months ahead, and it could boost the response rate closer to or above 90%. But of course, it could mean some big revisions to data and a lot of confusion about what that means. But from New York, that does it from us. Same time, same place next week. It's Bloomberg.